Well, good evening, everybody. I'm Ida Waldorf. This is my husband, Nathan Waldorf.
How you doing?
We have Brian Martinez here. He is the IRA specialist manager with New View Trust Company. He's helped seasoned investors and new investors alike using self-directed IRAs, HSAs, solo 401ks, and other tax-saving entities to build wealth. Since 2018, Brian has specialized in educating investors on how to purchase passive real estate in a tax-deferred or entirely tax-exempt vehicle with New View Trust. He exudes passion when educating others, and which is often overlooked in investments. Brian's primary focus is building relationships with local real estate investors, syndicators, investors raising capital, and those looking to do private lending using their IRA. He spends his free time enjoying Florida sunshine and networking in real estate conferences across the US. And so we welcome Brian here. He is being sponsored tonight by our team, Lake Highlands Fund. We are a group of syndicators, and right now we have this wonderful offering that we will briefly discuss. If you want to learn more, there's a little more information in that scan code, QR code. But without further ado, we will let Brian proceed. Welcome, everybody. Brian.
Hello. Thank you so much for having me. So I'm going to go ahead and share my screen. Make sure I'm sharing the right one. Let's see, can you see my presentation now?
Yes, we can see it.
Perfect. All right. Just wanted to make sure I was on the right one. Sorry, we have 3 screens here. So before I get started, just want to mention a few things. I work for a self-directed IRA company. We are not financial advisors. We're not CPAs. It's up to the clients to do their own due diligence before they make any type of investment. So we always suggest you consult with your attorney, CPA, or financial advisor, and make sure you do your due diligence before you make any investments. So we don't sell any investments, but we do put you in the right room. So we put on events, we do workshops, and we can educate you on the different types of alternative assets that you can invest in. So what are self-directed IRAs? So what self-directed IRAs, just like it sounds, it's self-directed. You choose your investment vehicle and your investment type, and then you direct the custodian exactly what you want to do, what your goals are, what you want to accomplish. There's some common types of assets that clients do prefer to purchase. And I'm going to go over quite a few of those, but we're going to focus mostly on real estate and syndications today. So the benefits of using a self-directed IRA are you get true diversification in your portfolio. A lot of times you have companies like Charles Schwab, Fidelity, Merrill Lynch. Those companies, they limit you to the stock market, and they might call your IRA a self-directed IRA. And what that means is they're just allowing you to choose from the stock market, the different stocks that you want to buy. However, having a true self-directed IRA and an alternative asset custodian allows you to diversify your retirement portfolio into things like real estate, mortgage notes, do private lending, cryptocurrency and precious metals. So there's quite a few things you can invest in. Also, there's a tax savings that comes along with that. Depending on the type of IRA you're using or some other types of plans that I'm going to mention, it could grow for you either tax deferred or tax free. And that's the ultimate goal. A lot of times you're already making these types of investments, but you're doing it with your own cash. Why not do it in an IRA where it's patient money that's going to grow for you and build your wealth that way? And not only that, invest in the things that you are already doing, you already know best. So these right here are the different types of plans. The first two I'm going to talk about are the traditional and the Roth IRAs. Those are the most common. Most people have a traditional IRA. The reason they have a traditional IRA is, say you worked for a W-2 job and you had a 401k plan or any type of employer plan and you left the company. That money, it's usually pre-tax dollars, and you have the ability to do a direct rollover into a pre-taxed IRA. So that would go into a traditional IRA. So most of the people that open accounts with NewView have a traditional IRA at first. Now, as we educate them, we teach them a little bit about using a Roth IRA. Roth IRAs are really powerful. That is a tax exempt type of IRA. So the way that works is you can invest the Roth money, which is post-tax money. You pay the taxes on the contributions, and it's going to grow for you tax-free or tax exempt, depending on the investment that you're making. Then you have your employer plans, and I'm going to dive deeper into these. Solo 401ks, you have your SEP IRAs and your simple IRAs. These are employer plans. So they do have higher contribution limits compared to a traditional or Roth IRA. So if you're one of those people that hasn't started an IRA, or you're just starting to build something and you don't have enough money, you might want to look at these employer plans, see if you're eligible, because they have higher contribution limits, as you can see on the screen there. Then you also have specialty plans. You have your education savings account, and you also have a health savings account. And like I said, I'm going to talk a little bit more about those. All right, so the Roth IRA. It's one of my favorite types of IRAs to have. The reason that I like the Roth IRA is because it grows tax-free. So most clients, like I said, they usually start out with a traditional IRA, but as we teach them how you can use a Roth IRA, they want to move their money into a Roth at some point, because they're making investments in things like real estate, where say I had a rental property, I know there's consistent cash flow coming in, or invest into a multifamily syndication, and I know it's going to grow pretty quickly. Well, I would rather pay the taxes on what I have in there now, because going forward for the rest of my life, it's going to grow tax-free or tax deferred. Now, there are some rules when it comes to a Roth. If you're a high earner and you make over $208,000 combined with your spouse a year, then you can't directly contribute to a Roth IRA. But there's this thing called a backdoor Roth, or a Roth conversion is what it is. So say you had that traditional IRA and you really want to put in a Roth, what you could do is you can convert it. So it means you're going to pay the taxes on it now, and now it's in a Roth because you pay the taxes on it, and then it'll grow tax-free. So that's called the backdoor Roth. A lot of clients like that strategy. And you don't have to convert the whole thing at once, because whatever you do convert, it's going to be added to whatever your taxable income is for that year, that calendar year. So this year, say you're in $100,000 and you had your traditional IRA and you converted, say, 20,000. Well, that might keep you in the same tax bracket. So that's okay. But if you converted, say, $30,000, that might push you into a higher tax bracket. So what I caution my clients to do is make sure you're able to pay the taxes on it, and make sure you talk to your CPA and see how much room you have that you can convert, that eventually you converted all that pre-tax money to post-tax dollars. So that's a strategy that you need to discuss with your CPA and see if it fits in your, your strategy for building your wealth in your retirement portfolio. Now, the traditional IRA, it's still a great vehicle and you can still invest it. And say you did invest that traditional IRA into a piece of real estate or some type of deal, and you want it to be a Roth, it's an in-kind conversion. So you can still convert it to a Roth while it's invested money. A lot of people don't know they can do that. They think it needs to be in liquid cash, and it does not. So those are the first two plans. Now we're going to cover some employer plans. These are really cool if you're qualified for them. The first one I'm going to talk about is the SEP IRA. So a SEP IRA, also some people call it like a self-employed pension plan. It's a good way to describe it. It has high contribution limits. You do need to be self-employed in order to be able to contribute to the SEP. And you can contribute, as of 2022, $61,000 a year to this plan. If you do have employees, whatever you contribute to your plan, you do need a match for your employees. So the maximum is 25% of your earned income, and the maximum is $61,000. So you'd have to earn $244,000 in order to max out that $61,000 contribution. But if you contribute 25% of your earnings to that SEP IRA, and say you have 2 employees, then 25% of whatever their earnings are must be matched by the employer. But it doesn't have to be 25%. That's just the maximum you can contribute. So you get to decide how much you want to contribute, but it's a lot higher of a contribution than a Roth IRA or a traditional IRA. Then you have your simple IRA. Now, this IRA is great for small businesses. The contributions aren't as high. and it has a mandatory 3% match for employees. So it's a little more realistic for those mom and pop companies. Maybe you have 3, 4, or 5 employees, where it's still affordable for you to contribute to your simple IRA as well as match your employees 3%. If you wanted to, and your employees are eligible, what a lot of people I see do is they partner all their simple IRAs together and invest in something like a piece of real estate or a short-term rental, or something where they can all partner together. I've seen that happen, especially like family-owned businesses. I do see clients doing that. That's the power of self-directed IRAs. You can partner on the investments with your other accounts. Okay, so now we're going to go into my favorite type of an account. This is called a solo 401k plan. You must be self-employed for the solo 401k with no employees. You cannot have employees in any of your business entities. Now, the solo 401k plan has some really cool benefits. So you get to make a contribution as the employee of your business, $20,500 as the employee. And then you can make contributions as the employer as well. The employer can match up to 25% of your earned income. Now, it's also 61,000 maximum you can contribute if you're under the age of 50, but the solo comes with a catch-up contribution. So if you're over the age of 50, there's an additional $7,000 you can contribute to that. So the maximum is $67,000 you can contribute to a solo 401k plan for the year 2022. It's a great plan. It was created because a lot of self-employed people are great savers, but they don't put their money into retirement plans. So that's why this plan was created. Another cool thing about it is it is a 401k plan. So with 401k plans, if you ever needed to take a personal loan from it, you can borrow up to $50,000. It cannot exceed more than 50% of the total value of the account, but the maximum you can take out is $50,000, and it's a loan to yourself. So you do have to pay it back. You pay it back over 5 years. You make quarterly payments with some interest. Interest is going to be prime plus 1%. So it's a little higher than your market rates. And not only that, this is my favorite thing about using a solo 401k. If you're qualified for the solo 401k, so I'm going to give you a little example here. Say I was buying a piece of real estate and I didn't have enough money in my IRA, so I had to take a loan out. This is called a non-recourse loan. That's the only type of loan that you can partner with an IRA. Well, now I'm making money from this rental property I own in my IRA. Well, the IRS says, hey, we're going to tax you on the leverage portion of your profit. So that borrowed money, I'm paying taxes on it, still making profit off of it. And I'm also paying the loan back. But my IRA is still going to grow tax deferred or tax free, depending on what the percentage is. And eventually I'll pay the loan off. And that tax is called UDFI tax, unrelated debt financed income tax. Now, if I did that same exact thing in a solo 401k and I borrowed some money to be able to purchase that real estate, it is tax exempt completely. There's no UDFI tax on there. So that's the only plan exempt from the UDFI tax. So that means you can borrow money and you can make your investment and it can still grow for you and you keep all the profit. Only the solo 401k allows that. There's a lot of cool other things with the solo 401k, and it's great to learn about that plan if you're qualified for it. I've seen people go to pretty big extremes just to open a solo 401k because of all the perks that do come along with that. But we can always talk one-on-one and do a consultation together and see if you're qualified. And then I'll tell you a little bit more about that plan and how it works. It comes with plan and trust documents and checkbook control as well. These are called specialty plans here. A lot of people don't know that these plans can be self-directed. So you have a health savings account or an HSA. So if you have a high deductible health care plan, that can be used just like a self-directed IRA. It's actually a little more powerful than any IRAs. I'm going to tell you why. When you make a contribution to a health savings account, it is going to be tax deductible. So that means when you're paying your taxes at the end of the year, that's going to help you reduce the tax burden because it's deductible. Now, when I invest that money and I start taking it out, which it can only be taken out from medical expenses, now it's going to be tax-free. So it goes in tax deferred and comes out tax-free. No other plan does that. So it's almost like having a traditional and a Roth IRA. It's a pretty cool plan. The contribution limits aren't as high. If you have a family plan, it's like $7,600 that you can contribute to the health savings account. But if you keep it invested or you partner with your other investments, that's how it's going to grow. And you'll be surprised. I've met a few people that have health savings accounts, and all they do is save their medical receipts and invoices and all their bills that they're paying out of their own pocket. and their health savings account is still working and growing for them, and you can keep it growing until you're age 65. The IRS does not say that you have to cash in all your medical expenses every year. You can keep that money working for you. And I've met a few people that have very high value health savings accounts in the $200,000, $300,000 range. So another way to build wealth. Then you have your Coverdell Education Savings Account. This is very different from a 529, because a 529 is meant, it's from the government, so it's not to be invested, versus the education savings account, you can invest it, and same thing, partner with your other investments. So it's only $2,000 you can contribute, but it's a great way to save for college for your kids or grandkids. And then, like I said, it goes for medical school expenses. It goes for your tuition, books, laptops, internet, anything that's a college expense it can be used for. So if you have young kids right now, it's a great time to start saving for them. I know myself, I'm going to be paying my student loans for the rest of my life. So I wish my parents would have opened an account like this for me when I was younger and made it partnered with some of their investments. And then maybe I wouldn't be stuck paying so many student loans. So that's something to look at as well. All right, so there are some restrictions when it comes to using self-directed IRAs. The thing with the IRS is they tell you what you can't do, not what you can do. So there's some gray areas. And like I said, you always want to have a good attorney or CPA that can help answer some of these questions. So these are the restrictions. First, your investment must be a passive investment and it must remain at arm's length. So what that means, I'm gonna give you an example of real estate. So you guys are all real estate investors here. Say I owned a piece of real estate in my IRA. I can't live there and I can't put any sweat equity into it. It's got to be passive. I could hire a property manager. I can hire contractors. Any third party can come in and do the work on there. But there's also some family members that are considered disqualified parties. So that's myself being the IRA owner, my spouse, my parents and grandparents, my children and grandchildren, and then any spouses of my children and grandchildren. So my ascendants and descendants are the disqualified parties. They can't live there, they can't rent it, and they can't provide any services or put any sweat equity into the property. Now, there are some family members that are not disqualified. People that can live there and rent it would be like brothers, sisters, aunts, uncles, cousins, nieces, nephews. Those people are okay. And there's a few other restrictions here, things that you cannot invest in. So the things that are completely non-investable are going to be entities that are owned by the disqualified parties. I would go through this whole chart, but it'll take me all day. So I'm not going to do that, but you will get a copy of the presentation. And you're also not allowed to invest in collectibles or life insurance. Those things are completely prohibited. Can't do those. All right. So life insurance and collectibles, can't do it. But these are things you can invest in. So you can invest when it comes to real estate, foreclosures, tax liens, multifamily syndications, storage, option contracts, condos. You can even buy offshore real estate. You can buy land, commercial property. So pretty much anything having to do with real estate, as long as you stick with the rules that I mentioned. A few other things that are pretty common that clients will invest in are private entities. So syndications would fall under actually private entities, not real estate. Even though you are investing in real estate, it's the LLC that you're typically investing in. And I'm going to go through what that process would look like. So any trusts, joint ventures, limited partnerships, LLCs, that's would fall under private entities, pre-IPOs. So like tech companies, if you're an angel investor, things like that. The process is really easy. So opening a self-directed IRA. First, you're going to fill out an application. It's your basic information, your beneficiaries, the fee schedule, and all the legal things you probably want to read and make sure you understand. So prohibited transactions, disqualified parties, those things that I mentioned. And then you choose what investment you want to use, what vehicle you're using. Are you using a traditional IRA, a Roth Ira, a SEP IRA, health savings account? And then you let us know what investment you're making. Once you figure out what you're going to do, you're going to provide us the investment documents. So if it's real estate, we need all the contracts. If it's a private entity, we need the subscription documents or the PPM. And the IRA is listed as the investor. So this is how it's titled. It's titled as a New View Trust, Custodian, FBO, which is for benefit of, and then your name. And now your IRA owns that property or has the deed or the shares in the LLC you're investing in. So that what reads as the investor, not you personally, but the IRA. Now, some people, they choose to leave their name completely out of there, and they can replace that with their account number. So you don't have to have your name on there. Some people say it's for asset protection purposes, completely up to you. So you can just replace your name with your account number once your account is opened. So you've made your investment, and now you have your dividends. Your payouts are going to be coming in, and they come right back to the IRA. And that's how it grows for you. And as it accumulates, you can start making other investments. And we do events where we can invite you to, so you can learn about all different types of assets that you can purchase in the self-directed IRAs. So like I said, real estate, it's the most popular thing we see clients doing. So you could do single or multifamily investments. You can invest in short-term rentals, fix and flips. Now, I do want to caution a few things when it comes to like Airbnb and fix and flips. Those might be subject to UBIT, which is unrelated business income tax. So if you're investing in any type of a business entity, you would be subject to business taxes, kind of like a hotel would be, because Airbnb from the IRS is perceived as a hotel. But it really comes down to what your intent is. I think everyone's intent is to build their wealth and build it in a tax vehicle that's going to be tax deferred or tax exempt. So that's the ultimate goal. Real estate contracts as well, commercial property auctions, any distressed property. My favorite is syndications. I network with a lot of syndicators. I love multifamily. I think it's really promising because people are always going to need somewhere to live. And I know for the first like 10 years that I moved to Florida, I rented, I lived in apartments, and it's really popular and common. And like, you've got to know where you're investing, of course. So college towns are really pretty common, pretty good investments, because there's always going to be college students that are going to be renting. You can invest in student housing, condos, hospitals. I mean, syndications cover a wide range of things. Mobile home parks, self-storage, those are all syndication deals. I've seen people invest in marinas and offshore real estate as well. And there's multifamily, it's offshore, starting to trickle in places like Belize, Nicaragua, what else, Venezuela. I'm seeing a lot more clients wanting to put money elsewhere because, you know, the market is a little interesting right now in the States. The inventory is low, but because the inventory is low, that means it's a seller's market. There's still a lot of benefit and a lot of advantage to that. So this is how it would work. So you complete what's called a purchase packet. It's really easy. It's a purchase authorization. You're basically giving the custodian the authorization to send your money to whatever the investment is. So there's just some basic information we need in there. First off, we need the supporting documents, like I mentioned. We need the wire instructions. So what bank will we be sending that money to? Is it, you know, Wells Fargo? Is it Bank of America? Double check those account numbers. If you're sending a wire, triple check them. Make sure it doesn't end up in the wrong account. So that's really, really important, because we're just going to take your word for whatever information you put on this form. It takes about 2 to 3 days to process your transaction, which is a great turnaround time. It's not bad at all. And always keep copies of all the paperwork for yourself through our client portal, or you can always email an IRA specialist and we can send that to you. So that's what we would need, is called a purchase authorization form along with the PPM or subscription documents. And once we have that, if you're buying real estate or doing a note, then we need a copy of the note, a copy of the mortgage. Same thing, we need wire instructions. Private equity. So we need, if it's a corporation, a syndication, a joint venture, it's going to ask all this information. So you need to know all these details, which is important. It's part of due diligence, so you know what you're investing in. Potentially, there are some great returns you can get in these type of investments. So you definitely want, like I said, due diligence all across the board, no matter what the investment is. So ask the right questions. We have lots of workshops in our database on our blog on newviewtrust.com. Go to our blog or our resources page, and you can just put real estate in there. There's a couple workshops on how you can do due diligence on things like multifamily or just real estate in general or private lending. There's a couple checklists you can follow as well. There's a lot of good content there. So yeah, exactly. Like I said, you need your PPM, operating agreement, subdocs, whatever documents you have, the more the better, and then the wire instructions. So the process is real easy to make investments. Where can you find the investments is another thing. What I like to do, I go to the RIAs, Real Estate Investor Association meetings. I join mastermind groups. I I mean, it depends on what your interest is, invest in what you know, but there's so many groups out there. I network on LinkedIn. I go to conferences and I want to learn more before I make any investments. So, there's a lot of different places, and here's some good websites that you can follow to find investments. But it sounds like everybody in this room's more interested in syndications. So there's a lot of conferences on syndications all across the country. A lot of stuff is virtual as well. Sometimes they're even hybrid. So if you can't make it there in person, it's good to network. And like LinkedIn has been a blessing during the pandemic for me, because that's how I've gotten to learn more about syndication, is network with more people about syndications myself. So we're going to go ahead and wrap it up there. If you want to stay up to date with NewView and any of our content, you can follow us on our social media. Go ahead and scan the QR code there. We're on Facebook. We have a YouTube page. We post all of our recordings on our blog section, as well as our resources section. And we're pretty soon going to be rolling out a new section. It's in the works. It's going to be a resource section where people can actually market their own investments, and clients can go there and shop for them, but you do have to be a client to have access to that. We haven't rolled it out just yet, but we're excited that it's going to be a new chapter, because this is something that's in demand right now. The stock market has been pretty volatile. A lot of people are losing money, or phones are ringing off the hook, and they want their money out of the stock market, and they want to put it in things that they can control, that they understand, and real estate's probably on the top of that list. So we'll go ahead and end the presentation there and open it up to some questions. So,
Anybody have any questions? Feel free to put them on the chat, or just let us know and we can unmute you.
Yeah, it looks like there's some things in the chat there now.
Okay, awesome. Go for it.
Oh, okay. I thought you were reading questions for me, but I will do that. All right. For multifamily investments, offering details on our website. Okay, so that's just the link to investing with Lake Highland Fund. How does NewView make money? Good question. Knew this question was going to come up. So our fees are actually really low. It's $125 a year, and that covers all your transaction fees, your tax filing paperwork. It covers your record keeping. So a lot of our competitors, they have like a bunch of like small fees that they charge here and there for everything. We don't. We bundle it all in a $125 fee that we just charge annually. And it actually saves the clients a lot more money. The only thing on top of that, yeah, you would pay would be wire fees. If you do any wires, you don't have to do wires. ACH is free. Checks are free. So that's an alternative to the wires. It just takes a little bit longer. So if you're in a crunch trying to get some money out quickly, then I would just say pay the $30 wire fee. And then we have another fee. It's $325 per asset. So per investment, it's going to be $325. We offer what's called Checkbook Control as well. A lot of companies don't have Checkbook Control, but Checkbook Control, basically you're creating an LLC where your IRA is the member, and then you open a bank account. Instead of your cash sitting here at NewView, it's available to you in that bank account in the LLC. In the IRS's eyes, that LLC becomes your asset. So we only charge you for one asset, which is the LLC. Now, within that LLC, you can make multiple investments, but we're still only going to charge you $325 a year and the $125 account fee. So that's going to save you the most money. If you're an avid investor and you want to have multiple assets in your account, you might want to look into the Checkbook Control option, because that will save you a lot of money. Let's see.
I have another question, Brian,
Okay.
if you don't mind.
Yeah.
Should the solo IRA be tied to an LLC?
The solo 401k be tied to an LLC. I have seen a few people create like a sub LLC for it. It already comes with Checkbook Control, but the reason that they do create the LLC is same thing for asset protection purposes, because the way a solo 401k is created, you're basically making a 401k plan for your company. So ABC Construction 401k plan, and then FBO for benefit of, and then the client's name. But sometimes they don't want their name on the documents, so they'll create an LLC where the 401k company is the member, just like the Checkbook Control I mentioned. So the member is the 401k, and they can name the LLC whatever they want to. So it doesn't have to be, but if your attorney says it's better for asset protection purposes, then yeah, you can definitely do that. It's an extra layer. What other
you.
questions? Can you explain why insurance and one other item you mentioned cannot be used when investing? Yeah, so life insurance and collectibles are prohibited. The reason that they are, so I'll give you an example with collectible. That is an easy one. I could look at this bottle of water right now and say this water right now to me is worth, $100, but somebody else might say, hey, it's already half drank. I'm only going to pay you $10 for it. It's not a collectible, but there's no fair market value because it's you can't really value collectibles. So that's why the IRS says you can't invest in collectibles. The other thing is life insurance. The reason you can't invest in life insurance policies is because life insurance is meant for after you die, not while you're alive. So they kept that completely off the board as well. There is still a way to invest retirement money into life insurance. It's called annuities. We don't do annuities here at NewView, but if that's something you want to do, you can. I don't know what the returns look like on that. I do know that there are penalties if you take the money out early. So it's kind of locked up. Sometimes there's like a 5-year minimum that has to be invested. But that's a different type of investment that we don't do here. Let's see. Tax filing. Do you have CPAs on the team? That's a great question. So the only tax forms that we do file for you, there's 2 of them. The 1099-R. So this reports to the IRS if you've taken any distributions or done Roth conversions. That we file for you. The other one we file for you is the 5498, reports what the fair market value of your assets are worth. Those are the only 2 forms that we will file, or we actually send them to you and you file it with your taxes. But there are no CPAs at NewView. We are not tax professionals. We are simply what you call an IRA custodian. So our job is just to really do the record keeping and do our best to try to keep you in compliance and not breaking any of the rules. So that's our main role. Let's see. For multifamily investments, offering details. Oh, sorry. Go ahead and visit the website, Lake Highlands Fund. Yes. That is not a question there.
Yeah.
Sorry.
Hey, so this is great, Brian. You did an amazing job presenting all the options. We are so thoroughly educated, and we're so thankful to have you as a resource, and for all these people to have to be connected with you if they want to take this one step further, for sure. So again, thank you for being here tonight. Thank you all of our investors and clients and friends that have joined, and our team members that have joined tonight that have sponsored this webinar. We are available for you guys if you want to discuss further the wonderful opportunity of using your tax deferred and tax-free funds to multiply your money. We have this offering in Dallas, Texas. It's it's a 2-property portfolio, 258 doors. The projections are for the 2 times your money on exit, 7% cash and cash return annualized, and 80 to 100% tax write-off, which depends on which instrument you use. And Brian can guide you on that, as can your CPA. If you would like to find out more information, please scan the QR code there. That'll take you to our website, which is www.lakehighlandsfund.wixsite.com/website. It is password sensitive, and the password is invest, and it's all lowercase. And we are so happy, so glad to have you all here. We're a resource for you should you choose to invest in this offering or any other future offering, or should you need further assistance for Brian, please don't hesitate to reach out to him. Thank you all so very much. Thank you, Brian, for your time. We really appreciate it. Everybody have a wonderful evening.
Just one more thing I want to put out there. I'm running a promo code just for this group only. So if you do reach out to me and you want to do a consultation, you can email me at IRA specialists. It's plural. So IRA specialists at newviewtrust.com. And the promo code is May 22. That's going to give you $100 off of your opening your account. So we're going to run that probably through the end of June for you, this group right here.
Excellent.
All right. Thank you.
What a great offering. Thank you so much.
Thanks for having me.
Thank you for your time. Have a wonderful evening.
Thank you, Brian. Thank you so much.
Thanks,
Thank you, Brian.
Thanks. We'll be in touch. Bye-bye.
Thank you. Bye-bye.